Welcome back. The S&P TSX Composite Index has also had a strong year of double-digit performance. Nonetheless, it has underperformed U.S. markets, and not for the first time recently. It has done so now for many consecutive years. Let's get back to Barry Schwartz. He's our guest. He's a Chief Investment Officer at Baskin Wealth Management for more on his thoughts on the Canadian stock market. What are your thoughts on the performance this year?
Yeah.
It came from the bank stocks in large measure.
For sure.
It didn't really come from the energy stocks, or not as much as typical. What do you think?
Royal Bank had a good year. Thomson Reuters, Constellation Software, obviously Shopify. I think Shopify's up 55%. So you take out those, and it's been a very tough year. You've had some nice moves from some of the smaller mid-cap names like a Bombardier or Celestica, which came out of nowhere.
Yeah.
I remember when Celestica was, they put together cell phones for companies, and all of a sudden it's an AI play.
Right.
And, no one really, everybody missed that name. So it's been a very tough index. Listen, it just doesn't have the right components for this new age of AI and digitization and healthcare, pharmaceuticals. We just don't have those companies. We have the boring, mature dividend payers. And of course, a lot of those lost their luster. The telcos just got absolutely destroyed. I keep seeing people saying, oh, it's okay if I buy them, I'll get my 8 or 9 or 10% dividend.
Right.
Well, maybe you won't. Maybe they're going to have to cut those dividends. It's not like they're growth names. And if we're reversing course on immigration here, if we're going to maybe allow more competition, this is not, the dividends are not guaranteed at 8, 9, or 10%.
Just before we move on, talk to me about Celestica in light of our earlier conversation where you think the big AI players deserve the higher multiples. This stock's now trading at 24 times expected earnings. What are your thoughts on Celestica and its current valuation?
I really have. I wish I could answer that. I really haven't studied the name enough. It's one that really surprised me. I, like a lot of other money managers, always thought this was a contract electronics manufacturing company, and turns out it has exposure to a lot of the right plays in AI, and so kudos to the management for pivoting and doing an amazing job. Okay,
so on the telcos, you're staying away, are you?
Absolutely.
The bull case on the telcos that I hear from some portfolio managers is the price war in the Canadian wireless business is likely over now. Pricing and competition may have troughed. It may get better from here.
Oh, good luck with that. Canadians still pay some of the highest cell phone prices, as well as so much competition coming in, whether it's Starlink, Google with its Coupier, or is that Amazon, I think, Coupier. There's more competition coming in broadband. I'd be very nervous to own these companies.
Okay. You talked in our prior segment about Restaurant Brands International as one of your picks. Flesh that out for us. Why is that one of your picks?
Yeah, we're actually surprised how poorly the stock has performed this year because Restaurant Brands did exactly what it said it was going to do. It's been investing in its underperforming Burger King, closing stores, improving some of the beautification of the stores, as I call it, digitization, for example, getting more ordering through, less through people. And that seems to be working. And in the meantime, we think the spending on the stores is going to slow in the next year or so. That will generate a lot of free cash flow. But the bottom line for Restaurant Brands, Tim Hortons, Popeyes, all their brands are performing very strong. The valuation is very inexpensive. Maybe some of the prices have gotten too high with inflation. They seem to be now offering more value deals, more value bundles. We think the stock is very cheaply priced heading into 2025.
How much of the company's footprint is in the United States? Popeyes and Burger King are predominantly U.S. franchises.
Well, this is an international business, right? I was away in Grand Cayman. There was actually Tim Hortons there, and there's Burger King's there. That's where the growth is, adding more franchises outside North America, whether it's in China, Indonesia, what have you. That's where the growth is going to come from. They think they can add multiple thousands of stores a year going forward, and that's, we think, a very attractive growth profile for Restaurant Brands. And as the Canadian dollar drops, the U.S. dollar translation is very good for Restaurant Brands.
Let's talk about commodities, a big part of the TSX composite. Energy, of course, but also the base miners, and neither had a great year in 2024.
Well, gold prices obviously were very strong, and you'll have more to talk about that later on. But, There's nothing wrong with the $70 oil with a 69-cent Canadian dollar.
Yeah.
We should not cry for the Canadian oil sands companies. Maybe things got a little bit too excited earlier this year. We still love Canadian natural resources. We still think this is a 30-plus year story. Royalty with $65 to $75 oil. Canadian natural resources should raise its dividend every year for the next 30 years. We see
why is it not being recognized in the CNQ share price?
We can't rationalize stock price movements, but over the long term, if they continue to grow earnings and production, the stock price will rise. The other exciting name in our portfolio is Tourmaline Oil. We see natural gas prices start to tick up as concerns about very cold weather heading into eastern Canada, eastern United States over the next few days. And in the meantime, of course, the demand for natural gas to keep all these data centers running, electricity going is going to be very tremendous. We think this is the year for natural gas companies. We think the next few years, Tourmaline Oil is going to be one of the best performers on the Toronto Stock Exchange.
Why don't we finish with the base metal miners, copper and the base metal miners, Teck Resources as the flagship?
Yeah, so I mean, they're trying also to pivot themselves as AI companies. You know, we need all these EVs, robotics, data centers, everything needs copper. The problem, of course, is it's such a competitive business. Pricing is so hard. You never know where the next amount of copper is going to come from. You know, if I was going to play resources in Canada, Teck would obviously be the company to own. They've done a great job pivoting and focusing on copper exclusively. Well-run company. I think it had a good last year in 2023, maybe not so good in 2024. Its balance sheet is in great shape. So this is one that I would possibly consider.
Barry, thanks for joining us and Happy New Year.
Happy New Year to everybody.